something is happening that most people haven't noticed yet. The world's biggest investors are all moving in the same direction, and that direction is Africa. This quiet realization is happening in boardrooms most people will never see. Not in Nairobi, not in Lagos, not in Kigali, not in Accra, but in London, New York, Dubai, Singapore, Shanghai, in rooms where pension funds, sovereign wealth funds, logistics firms, mining giants, telecom operators, asset managers, and infrastructure investors study maps of the future. And on those maps, one region keeps getting brighter. Africa. Not because the world has suddenly become moral, not because global capital has developed a conscience, not because investors woke up one morning and decided to care about African development. That is not how capital works. Capital does not move because of sympathy. It moves because of timelines. It moves because of forecasts. It moves because someone somewhere has looked 20 years ahead and concluded that the center of gravity is shifting, and increasingly, that shift points south. For centuries, Africa sat inside the global economy as a source of labor, a source of gold, a source of rubber, a source of cocoa, a source of copper, a source of oil, a source of uranium, a source of cheap extraction, but not in the eyes of the old order, a center, not the place where the future would be designed, not the place where high finance expected the next great wave of consumers, workers, cities, and strategic markets to emerge. That assumption is now breaking because global capital has read the numbers. It has looked at Western aging. It has looked at declining birth rates. It has looked at saturated consumer markets. It has looked at debt-heavy old economies and fragile political systems. Then it has looked at Africa, at its population curves, its urban growth, its digital leapfrogging, its mineral leverage, its trade corridors, its underbuilt infrastructure, its future labor force, its rising market size, and it has concluded something profound. The future cannot be built without Africa. That is why global capital is moving in. The question is not whether Africa is becoming important. The question is whether Africa will finally negotiate from importance. If you value stories that go deeper than headlines, subscribe. On this channel, we look at the systems beneath the story. Now let's begin where this story truly starts. Not with investment, but with history. Part 1. The old map of global capital. Before global capital began moving into Africa as a future market, it moved through Africa as an extraction system. That distinction matters because Africa was never excluded from the world economy. It was included violently, included unequally, included as a provider of inputs rather than a co-author of value. For centuries, wealth moved out of Africa and into the Atlantic world, first through people, then through land, then through minerals, crops, shipping routes, and financial dependency. The transatlantic slave trade turned human beings into moving capital. Millions of Africans were shipped into plantation systems that helped build the wealth of Europe and the Americas. This was not just demographic theft. It was structural distortion. Communities were hollowed out. Wars were incentivized. Ports were reorganized around export. Political systems bent around outside demand. Then came colonial rule. By the late 19th century, the scramble for Africa formalized the continent's role inside a world economy dominated by Europe. Colonial administrations built infrastructure, yes, but not for African industrial transformation, not to integrate African markets internally, not to build balanced national economies. Railways went from mine to coast. Roads went from plantation to port. Telegraphs went from colonial office to commercial center. The economic logic was brutally simple. Move value out, move manufactured goods in, keep the colony dependent. And when formal colonial rule ended, the architecture of that dependency did not disappear. Flags changed, anthems changed, presidents changed, but the structure often remained. Many African states inherited economies built around a narrow range of commodities. Copper in one place, oil in another, cocoa elsewhere, gold, bauxite, uranium, cotton, coffee, diamonds. Export one or two things, import everything else. Borrow when prices fall, adjust when creditors demand it. That is why many African countries entered independence politically sovereign, but economically positioned inside a world system that still expected Africa to supply the inputs and buy the finished goods. This is important because it explains the difference between old capital and new capital. Old capital came to extract. New capital is still extractive in many cases, but it is also doing something else. It is positioning itself for Africa not only as a source, but as a future site of markets, logistics, energy, labor, and industrial relevance. That is the shift. And to understand why that shift is happening now, we have to examine what is happening to the old center of the global economy. Part 2, the West under strain. The phrase decline of the West is often used emotionally, too emotionally, as if the West will simply collapse tomorrow and vanish into history. That is not what is happening. The West remains immensely wealthy. It remains technologically advanced. It still controls powerful universities, financial markets, military alliances, media systems, and industrial capabilities. But what is changing is not existence, it is monopoly. The West no longer possesses the same uncontested hold over the future that it once assumed was permanent, and capital sees that clearly. Start with demographics. Demography is not ideology, it is arithmetic. Across Europe, fertility has fallen well below replacement. Across North America, fertility is also low. In country after country, populations are aging. Median ages are rising. Working age populations are slowing or shrinking. This creates long-term stress in at least 4 areas: labor supply, consumption growth, pensions and healthcare burdens, and political conflict over immigration. Old societies are becoming older, and aging societies do not consume, build, risk, and grow in the same way younger ones do. That does not make them irrelevant, but it changes the horizon of investment. Then there is market maturity. A great deal of the Western world is already deeply built out. The consumer economy is large but saturated. Infrastructure is mature, but often aging. Household formation is slower. Growth is harder to generate organically. In many cases, the old engines of easy expansion are already exhausted. Then comes the social layer. Marriage rates have declined in many Western societies. Single adult households are rising. Trust in institutions is weakening. Many young people feel priced out of the life stages that once defined middle-class stability: home ownership, family formation, long-term security. Again, this is not a moral lecture. It is a structural observation. If social institutions weaken while inequality rises, long-term confidence declines. And confidence matters because modern economies are not built only on money. They are built on belief. Belief that institutions work. Belief that the future is worth planning for. Belief that the system, however imperfect, still has room for you. When belief erodes, politics becomes volatile. And that is exactly what we are seeing: polarization, institutional distrust, policy reversals, short electoral cycles, fractured public spheres. Now add geopolitics. The post-Cold War era created the illusion that Western dominance was natural and permanent, that the United States and its allies would remain the center of global finance, production, security, and legitimacy indefinitely. But reality has become messier. Wars have returned to Europe. Military spending is rising again. Trade tensions between Europe and the United States have grown. Industrial policy is back. Energy dependencies have been exposed. The old alliance remains powerful, but it is no longer frictionless. And in world politics, friction matters, because friction weakens predictability. And when predictability weakens in the old core, capital starts searching for the next geography of growth. Not instead of the West, but beyond it. That is a crucial distinction. Capital is not abandoning the West out of spite. It is diversifying beyond it because the future growth curve is no longer expected to live there alone. And that leads directly to Africa. Part 3, Capital has read the future. Here is the single most important point in this documentary. Global capital is not moving into Africa because Africa has already become the center of the world economy. It is moving because capital believes Africa is becoming unavoidable in the next one. That is a major difference. Capital does not wait for a transition to finish. It tries to arrive before the crowd, before assets become expensive, before competitors dominate the space, before governments tighten the rules, before infrastructure corridors are fully claimed, before supply chains are locked in. It moves early when it believes the trend is irreversible. And the trends here are powerful. The first is population. Africa is the youngest continent on Earth. Over the coming decades, it will account for an enormous share of global population growth. By mid-century, 1 in 4 human beings may be African. That means something larger than headline optimism. It means future workers, future families, future cities, future schools, future transport systems, future food demand, future housing demand, future telecom demand, future banking demand, future healthcare demand, future political power. A young population does not automatically create prosperity, but from the perspective of long horizon capital, it creates something very important: time. A time horizon for building markets, a time horizon for financing urban growth, a time horizon for installing payment systems, energy grids, logistics platforms, industrial parks, and consumer brands. Old societies can be rich, but they do not offer the same long runway. Africa does. This is why the phrase "Africa is the future" keeps appearing. But here is the more precise version. Africa is where a large part of the future customer, worker, commuter, renter, builder, and borrower will live. And capital understands this. That is why it is moving. Part 4. Africa's consumer story. For decades, many external observers looked at Africa and saw poverty first. What global capital increasingly sees now is scale. Scale is one of the most underrated concepts in economics. A market becomes attractive not simply because people are rich today, but because the total number of people entering monetized, urban, connected life is growing rapidly. A city where millions of people are opening their first bank accounts, using their first smartphones, joining formal retail markets, taking transport daily, consuming electricity more regularly, renting apartments, buying insurance, and sending digital payments can become one of the most exciting investment environments in the world. That is what parts of Africa increasingly represent. The rise of fintech in places like Kenya and Nigeria showed global investors something important. African consumers were not waiting to become Western before entering the future. They were leapfrogging into it. Mobile money, digital wallets, agent banking, cross-border payment systems, small-scale digital commerce, telemedicine, online education, platform logistics. These are not just trendy categories. They are signs of a continent building consumer systems at speed. Capital notices these signals because they reveal not just need, but conversion. Need by itself does not attract serious capital. Need plus monetization does. Once investors see that millions of people are not only underserved, but increasingly reachable through digital rails and scalable platforms, the narrative changes. Africa stops looking like a developmental burden and starts looking like a market formation story. And market formation is one of the most profitable moments in capitalism, because that is when loyalties are fluid. Standards are not yet fixed. Infrastructure is still being chosen. And whoever arrives early can shape the rules. That is why telecom capital, fintech capital, payments capital, logistics capital, and platform capital are all increasingly paying attention. They are not arriving because Africa is fully mature. They are arriving because it is not. Part 5. The minerals that power the future. If demography is one pillar of Africa's attractiveness, critical minerals are the second. This may be even more decisive. The global economy is entering an energy and technology transition. Electric vehicles, battery storage, data infrastructure, grid modernization, wind systems, solar systems, advanced electronics, defense systems. All of these require materials, and many of those materials are found in Africa. Cobalt, copper, lithium, manganese, bauxite, graphite, rare earths, uranium, platinum group metals. This changes the conversation completely, because Africa is not just a possible market in the future economy. It is a material precondition for building that economy. Take cobalt. The Democratic Republic of Congo dominates global supply, Take bauxite. Guinea matters enormously. Take copper. Zambia and Congo are central. Take lithium. Zimbabwe has become increasingly important. Take manganese. South Africa and Gabon matter. This means that the green transition, the battery transition, the digital infrastructure transition, and even parts of the military-industrial transition increasingly run through African ground. Global capital sees this clearly. Mining firms see it, governments see it, battery manufacturers see it, sovereign wealth funds see it, logistics players see it, because once future industrial systems depend on your minerals, your relevance rises. But here lies the danger. If Africa only exports the raw materials and imports the refined products, then the future will look suspiciously like the past. Raw out, value in, extraction there, profit elsewhere. That is why capital is moving in not only for the minerals, but increasingly for control over their pathways. Mines, processing facilities, power supply, rail lines, port access, offtake agreements, industrial policy influence. This is not random. It is strategic positioning around the future supply chain of the world. Part 6. The Infrastructure Frontier. There is another reason global capital is moving into Africa. Underbuilding. That sounds negative, but from an investor's perspective, underbuilding can represent opportunity. In mature economies, much of the infrastructure is already there. Ports are established, power grids are dense, rail systems exist, fiber networks are mature, industrial land is expensive, room for first-mover advantage is limited. Africa is different. Many parts of the continent remain deeply underbuilt, not because they lack importance, but because history left them structurally undercapitalized. That means roads are needed, ports are needed, warehouses are needed, cold chains are needed, transmission lines are needed, fiber backbones are needed, data centers are needed, industrial zones are needed, mass transit is needed, housing finance systems are needed, payment rails are needed. From the outside, that can look like weakness. But to infrastructure capital, it also looks like runway. An entire terrain where logistics systems, digital systems, and physical systems are still being built. This is why Gulf capital is entering ports and corridors, why Chinese firms have invested heavily in rail and logistics, why digital infrastructure firms are watching African internet growth, why data center operators are increasingly interested in Nairobi, Lagos, Johannesburg, Casablanca, and beyond. Why industrial parks and special economic zones keep reappearing in conversations about Africa's future. Because underbuilt systems are not only deficits, they are also first draft markets, and first draft markets can be very profitable. For a while, globalization encouraged the fantasy that geography mattered less, that capital could move effortlessly, production could happen anywhere, and the world would flatten into one integrated market. That fantasy is over. Shipping disruptions, war, sanctions, pandemics, energy crises, Red Sea insecurity, semiconductor bottlenecks. All of these have reminded the world of something old. Geography still decides power, and Africa's geography is becoming harder to ignore. Look at the map. The Mediterranean edge, the Red Sea, the Bab el-Mandeb Strait, the Suez-linked corridor, the Cape Route, the Gulf of Guinea, the Atlantic coast, the Indian Ocean gateways. Africa touches some of the most important trade arteries on Earth. As maritime insecurity rises and supply chains become more political, ports, corridors, and choke points gain value. This is why shipping capital, logistics capital, port capital, and state-linked strategic investors are watching African coastlines closely. Not every country will benefit equally. Not every corridor will win. But the continental relevance is rising. And here again, capital is positioning early. Because whoever helps build the next port, rail, or logistics chain often becomes part of the long-term system of influence around it. Infrastructure is never just infrastructure. It is power in physical form. Part 8. Multipolarity has changed the game. Another major reason global capital is moving into Africa is that the world is no longer unipolar. In the old model, Western capital often behaved as if Africa had nowhere else to go. The IMF here, a European buyer there, an American security framework in the background, a narrow menu of options. That world is changing. China is deeply present. The Gulf states are highly active. India is expanding commercial ties. Turkey has moved aggressively in trade and diplomacy. Russia remains important in some security environments. Western capital is still powerful, but it no longer acts alone. This has one very important consequence. Africa matters more because more powers need something from it. Votes, markets, ports, minerals, land access, shipping influence, security partnerships. And whenever multiple actors need access to the same geography, that geography becomes more valuable. This is one of the main reasons capital is converging now. Africa is no longer seen as a side theater. It is increasingly seen as one of the major arenas where the future balance of the world economy will be negotiated. That does not automatically benefit Africans, but it does increase bargaining relevance. The old monopoly has weakened, options have multiplied, and capital follows competitive openings. Part 9. What kinds of capital are moving in? It helps to be specific. When we say global capital, we should not imagine one giant faceless machine. Different kinds of capital are moving into Africa for different reasons. Sovereign wealth funds are looking for long-term strategic positioning. Infrastructure funds are looking for stable returns from ports, grids, and transport systems. Private equity is hunting for scalable firms in fintech, logistics, healthcare, education, and consumer markets. Mining majors are positioning around critical minerals. Telecom capital is chasing connectivity growth. Data center capital is moving where digital demand is climbing. Agribusiness capital is looking at land, supply chains, and food security. Energy capital is watching power generation, renewables, gas, and transmission. Development finance institutions are trying to crowd in private investment where risk is still high. This diversity matters because it proves something important. Africa is no longer receiving only one kind of money for one kind of reason. It is attracting multiple streams of capital across multiple sectors because investors increasingly see the continent as a layered future. Not just mines, not just aid, not just extraction, but energy, logistics, finance, telecoms, urban growth, and strategic manufacturing. That is a major shift. Part 10, they are not coming to rescue Africa. Capital is moving into Africa because it sees value, not because it seeks justice, not because it wants to correct history, not because it has fallen in love with African development. Capital may help build things. It may finance power, ports, payments, roads, data centers, rail lines, and industrial parks. But it does so because those things can produce returns, access, leverage, and influence. That means Africa faces a double reality. This inflow is an opportunity, but it is also a risk. Because if African states negotiate badly, then capital will reproduce the old pattern in new language. A greener scramble, a digitized scramble, a corridor scramble, a critical minerals scramble. The slogans will sound modern. The extraction logic will remain old. This is why the real question is not, why is capital coming? The real question is, what is Africa demanding in return? Local processing, technology transfer, supplier development, training, standards infrastructure, refining, manufacturing, domestic revenue, grid investment, regional integration. If those things are missing, then Africa may again provide the future without owning enough of it. Part 11. Why the timing is so urgent. One reason this moment matters so much is because capital is not only chasing opportunity, it is also driven by fear. Fear of being late, fear of missing the next major growth zone, fear that a rival fund, rival state, rival port operator, rival mining firm, rival telecom player, rival payments platform, or rival sovereign wealth vehicle will claim the future first. This is how capitalism often works. People imagine investors making calm, rational, long-term decisions in perfect serenity. Sometimes. But often what accelerates movement is fear of exclusion. Once enough large actors conclude that Africa's importance is rising, waiting becomes dangerous because assets become more expensive later. Regulations may tighten later. Political access may narrow later. Corridors may already be claimed later. Local champions may become stronger later. So capital moves now. not because Africa has fully arrived, but because investors believe it will matter too much to ignore. This is one of the reasons the current rush feels so broad. Everyone is trying to get ahead of the same future. Part 12, Africa's Window of Opportunity. Now we come to the most important part. What should Africa do with this? Because the arrival of global capital by itself solves nothing. Many places have received money and remained dependent. Many places have hosted extraction and stayed poor. Many places have welcomed investors and lost control of their own strategic assets. So this moment must be read correctly. Africa's advantage is not that capital is finally kind. Africa's advantage is that capital now needs access to things Africa can increasingly price: its market, its labor, its minerals, and its geography, its growth. That creates a bargaining window. But a bargaining window only matters if there is bargaining capacity, which means states must think strategically. Regional blocs must think strategically. Industrial policy must become serious. AFCFTA matters here, because a fragmented Africa negotiating country by country will often still be weak. But a more integrated Africa with corridor strategies, market scale, local content demands, tax coordination, industrial standards, and shared bargaining power can extract far better terms. That is the deeper opportunity, not simply attracting capital, but disciplining it, steering it, forcing it to leave more behind, turning inflows into sovereignty rather than dependency. That is the real test. So why is global capital moving into Africa? Because it has already concluded that the future cannot be organized without Africa. It has seen the aging West, the slowing labor pools, the saturated consumer markets, the fractured politics, the limits of old monopoly power. Then it has looked south at Africa's youth, its cities, its minerals, its corridors, its digital leapfrogging, its underbuilt systems, its future scale. And it has made a calculation, not a moral judgment, a calculation that the next great theater of accumulation, production, logistics, and market formation will increasingly run through Africa. That is why the money is coming. But capital does not arrive to liberate, it arrives to position, which means the final question is not whether Africa is becoming important, it is whether Africa understands how important it has become. Because if it does, then this could mark the beginning of something historic, a shift from being the world's quarry to becoming one of its makers, a shift from being a zone of extraction to becoming a zone of negotiation, a shift from being acted upon to becoming strategically central. But if Africa misreads this moment, then the future may look painfully familiar. New investors, new language, same old pattern. That is the choice hidden inside this convergence. Global capital is moving in. The future is circling the continent. Now Africa must decide whether it will simply host that future or shape it. If this changed how you see Africa's place in the world economy, subscribe. And tell me in the comments, do you think Africa is ready to negotiate from strength, or is it still in danger of becoming the raw material base of another century? Stay curious. Stay sovereign. I'll see you in the next.